Good afternoon, ladies and gentlemen. Welcome to Business Today Television. In our ongoing special series of market gurus in and around the budget, we welcome some of the finest individuals on Dalal Street, professionals who have made money over the last 3 decades for their clients in all sorts of markets, roaring bull markets such as now, bear markets, sideways markets, and volatile markets. Our guest today is Mr. Jyotivardhan Jaipuriya. He's the founder and MD at Valentis Advisors Limited over the last 8 years. A gentleman who's extremely quiet, soft spoken, and very, very intelligent when it comes to navigating the ups and downs on Dalal Street. Jyoti was earlier with Bank of America for a period of 21 years, and before that he spent 8 years with ICICI Bank. All told, 36 years of well-rounded personality in front of you. At the moment, managing 1,500 crore rupees, which have grown at a compounded 21% over the last 8 years. Namaste, Jyoti ji. What a pleasure to have you on Market Guru. And as we were discussing before the show started, market में ज्योति छोड़िए बिल्कुल आग लगी हुई है. बताइए, how do you feel about sentiment on the Dalal Street, and is it overheated? Is this the right temperature, or are we still have a lot of rallies to go?
Yeah, so it's obviously done very well. So anybody who's been in the market for the last few years has seen returns which are probably more than what one thought, let's say, when COVID was hitting us. So market is not cheap. That is like the easy thing to say. It is a market where you have to be a little cautious. The way I put it is, now the T20 is over. We have to start playing a test match now and not play a T20. We played a T20 for the last few years in the market. So from here, its money will still be made because the Indian macroeconomy looks good. So the twin deficits are under control. Growth is going on, and India probably is going to be one of the fastest growing economies in the world for the next few years. And there's a lot of positivity in India. So money will be made. At the same time, you have to be a little cautious now, just given where valuations are, because the market is not cheap. There's been run up in a lot of sectors and stocks. In fact, if you go through it and compare it with, let's say, the 5-year trading average Ps, none of the sectors really look outstandingly cheap or something. So money will be made because growth will come, but probably return expectations have to be toned down. And the second is you have to be ready for more volatility, because we had one dream period where market you bought a small dip, also it went up. So you probably will have to be ready for a bit more volatility at the moment.
Jyoti, you are a very well-known stock picker, and a maximum amount of money people have made are into mid caps and small caps. As a percentage of the two PMS schemes that you offer, smalls and mid caps are a larger percentage than large caps. How do you see this environment where indices alone have risen 26-27% year to date, and over a 3-year period have more than doubled? In one case, they've gone up 2x. Is this froth in the market? Is this pain in the market in the offing? Or are we par for the course?
So, what we have to remember is during this same period, earnings also went up. So, you had a rally in the market, but that was accompanied by a very high earnings growth. Over the last 3 years, the small cap earnings growth has been compounding at close to 40%. So to that extent, that explains part of the rally. Having said that, the markets are not cheap. Like I said, the large cap itself is, probably slightly expensive, and the small caps, mid cap, especially the mid cap more than the small cap, is even more expensive. We could justify it in terms of, from here, probably the returns in the large cap will be more or less equal to the earnings growth. The returns in the small and mid cap probably will be lower than what the earnings growth is, because some of these valuations will normalize. As long as the economy keeps doing well over the 3-year, 4-year period, you'll make money both in large caps and in small cap and in the larger. So my view is you'll probably see a better return even from these levels in a smaller cap if the economy continues to grow. But the margin of safety has gone down. Short term, it is possible and it's likely that when and if the markets correct, you have a bigger correction in the small and mid cap than you have in the large cap. So anybody who's investing now has to be ready for that volatility. I advise is to not invest in one go, but probably, spread out your investments over the next few months.
Fair point. Jyoti, there was a time when we used to get 40,000 crore rupees as annual 18-month inflows into mutual funds while you were at Bank of America Merrill Lynch. And here is an instance in the month of June, we have 40,000 crore rupees coming into mutual funds alone. Uh, you know, are these, of course, these are times to enjoy these. We've waited for 3 decades to see this kind of a market and this kind of maturity and these kind of inflows. But, do you feel a little edgy, a little bubbly when it comes to these kind of prices? On a daily basis, there are sectors where a couple of stocks hit 20%. It gives me the chills. But how about you?
Yeah, so, again, here's the long term and the short term. So the long term, I'm happy that Indians are finally investing in India because if you look at Indian percentage saving in equities, it's probably one of the lowest in the world. And low
Yes.
compared to emerging markets is very, very low compared to developed world. So to that extent, I think we are still very, very underinvested and a lot more money needs to come to Indian equities. But the only concern I have shorter term is that over the last 3 years, we've seen probably a doubling of the investor base. A lot of them have not seen what is a correction also, forget like a bear market. So to that extent, maybe people are like getting a bit too complacent on the market. Returns have made them complacent. And so, it's a learning exercise, right? You'll have a correction. They'll, figure out that returns are not that easy to make. And hopefully all of them will then stay for the long haul and tone down the return expectation. But yeah, short term, we could see some pullback. And then, for people who have not seen sort of pullback in the market, it may be a bit of surprise element coming through.
Fair point. Unless you see pain in the market, you never appreciate the rallies that at least people like you and me are doing at this point of time. We've seen times when the Nifty's opened gap down and then on the next day fallen another 10%. So those were frightful days, and we've lived through them, and we are enjoying the ones that we see these days. Jyoti, is this move that we are seeing on Indian markets, one of those island of safety kind of moves globally? Because Asia isn't doing as well. Europe more or less has been a forgotten story. The two bull runs that are happening secularly are either in India and the US. How do you see the global picture as far as Indian equities are concerned? And till when do you see a rate cut coming in?
So yeah, I don't know, like if you just think of India, if you see the foreign flows, they've not been very high. And the reason foreign flows are not high, in spite of the fact that it's very consensus, most people believe India is going to do very well as an economy. It's going to be one of the fastest growing economies in the world over the next few years. It is not high because of valuations. So if you look at, any of the global emerging market funds, when they look at valuations, India trades at like 20 plus P. And, if you take the index itself, it's probably trading at around 11 and a half P. So for them, it becomes India trades at like, 80% premium and on a P basis. So for them, it's the valuation very high. Most people want to buy India if they can get a correction in the Indian market. But at these valuations, that's why we've been seeing some selling. In fact, there have been one section of people who are saying, China is so beaten down that though longer term there are lots of things going wrong for the Chinese economy, maybe the market is at a stage it's underperformed so much. There's, total pessimism on China that maybe the market will does better than India, at least in the next 6-8 months. So that's why people love India long term, but short term everybody is hoping we get markets to be cheaper. And like you said on the Fed cuts and the interest rate cut, uh, I think we'll get at least one rate cut in this calendar year. Maybe we get two, and probably the next year we get another 2 or 3 interest rate cut coming. Which typically has been good for emerging markets. And you start seeing flows come to emerging market, and India will get its fair share also.
Fair point. So, two rate cuts in calendar 2024. We are sitting on 10th of July. Almost half the year is sort of out in history. Let's see how it pans out. Jyoti, if you look at the valuation profile of the Nifty in particular, we are trading somewhere like 9-10% above the 5-year average as far as PE is concerned. Are there pockets of, how should I say, overvaluations in large caps which you think may be problematic, or is the large cap space looking good to you?
So see, I would say the large cap is relatively okay on valuations. It is not
Yes.
cheap. It's a little expensive. But what we would have is we've not seen like a range bound market also. So from my point of view, like maybe a time correction over the next 6 months, where the
Okay.
index remains high for the next 6 months, could cover a lot of these valuations, and you may say, okay, we are coming back to maybe it's the top end of fair valuation range, but we are coming back to the fair valuation range. So it would be so like, there may be some price correction and maybe some time correction, which tends to take care of this 10% sort of valuation which we are looking at. So probably, you have the same index after 6 months with a bit of fall and a bit of going up, and you start saying, okay, this is reasonable. I can live with this sort of stuff.
Fair point. The other instance in the market is, of course, the quarterly earnings which are upon us. Tomorrow is a day which is kick-started by TCS. IT, in any case, hasn't been on the radar of PMS managers such as you, and it's more or less now, under-owned, underappreciated, and not looked upon as a wealth creator. How do you see the earnings in general for the second quarter, and what is your view on large cap software?
So earnings in general, I think, will be weak. They'll be weak in the sense that, uh, what we had last year was earnings growth, which was in the range of 24%. This year, we are expecting earnings to be in the range of 12 to 13%. So to that extent, it will be much weaker than what we've seen in the past. Some of the factors which will drive down earnings is, you had a very sharp jump in bank earnings over the last 2 years. And that bank earnings will still grow, but it will grow at a much, much smaller pace. So that's one thing which will start dragging down earnings. There'll of course be some one-offs on the oil marketing companies, which I generally tend to ignore. But in general, you had a phase where in the first part post-COVID, you had a huge top line growth. Then you had a big margin expansion. So to some extent, now that margin expansion is baked in, you're not going to have this sort of margin expansion coming through. So, we'll have earnings which tend to get closer to the nominal GDP growth than the earnings which were way above the nominal GDP growth. The quarterly earnings will also probably reflect that sort of earnings growth, where earnings are going to be probably high single digit sort of growth on the Nifty stocks for the first quarter.
Okay, fine. So basically, nominal GDP growth is what you expect in overall earnings performance, if I'm not mistaken.
Yeah, so basically maybe 12-13%, so slightly above normal GDP growth.
Fair point. So that's the number that is being penciled in as far as earnings are concerned. Jyoti, the other point in the market at this stage is this the entry of Indian bonds into the JP Morgan index. There's no better person on the Lal Street than you to perhaps respond to what the outcome would be 2.5, 3 years down the line for the Indian economy. At Bank of America Merrill Lynch, I'm sure this is something that you must have addressed to your global clients, that Indian bonds are now sort of globally acceptable. How do you see this dramatic change impacting the economy and, of course, the markets in general?
Yeah, so like what this does is opens up one more avenue of FII flows. Because it's in the index, it gets easier to attract that sort of money. So when you look at the funding cost in India and you have more money coming into the bonds, it basically lowers down your funding cost. Ultimately, today, if you look at the economy, one of the critical things over the next few years is going to be that does the private sector capex come back? Because if the private sector capex comes back, then the whole economy growth can be in the 7 to 8% range. For that, interest rates and availability of financing will be one important factor which will, swing capex. So here, getting this Indian bonds into the JP Morgan index helps because it, ensures money coming from overseas, and it basically brings down the interest rates in the country.
Okay. So basically, it might over the longer period of time kickstart the private capex cycle into a higher orbit, because not only will local interest rates go down, but corporates will be able to access cheaper money. Is that right?
Yeah, that's it.
Okay, perfect. So let's hope we look forward to that day as well over the next 3.5 years, when the Indian 10-year yield, slips below maybe 5%. That will be a day to look forward to. The other part within your portfolios at Valentis, Jyoti, is there a space that you've missed? Maybe this very sharp rally on defense, maybe this very sharp uptick that we are seeing on railway stocks. Are these sustainable? Given the stories that we are hearing about, long term upcycle coming in defense, order books being talked about, problematic neighbors, problematic world. Is this a story that you buy into, or are these just marketing stunts?
So, if we look at defense, we look at railways. So, what we agree with is there's a big scope ahead. The government wants to, get more and more defense made in India, partly because it is cheaper, and partly because, you want to safeguard yourself from any external pressures. So, in a longer term basis, over the next 5 years, you'll have more and more uh, defense budget going to Indian companies rather than from imports. At the same time, when it comes to buying a stock for us, it is maybe they're pricing in too much too soon, because the valuations on these are very high. We generally tend to look for margin of safety. That if something goes wrong, then where are we? Just now, the stocks are pricing perfect implementation for the next 5 years. That orders come, we implement it, margins remain there. And that's why, we are very cautious, because for us, unless there's a margin of safety, we don't like to buy it. And so we're generally avoiding these sort of names in the portfolio just now.
Fair point. And your answer naturally prompts me to ask the next question. Where is margin of safety still left in a market that's in the 49th month of its bull run?
So, obviously the margin of safety has come down across the board. But we tend to, we have this whole philosophy, which is the 3 U's. So we buy undervalued stocks which are underowned and which have underperformed. So we tend to go where stuff is underperforming, where, earnings will turn around. So one area which we've been looking at has been the banks, which, has done very badly for the last 15 months. So banks have value per se. There is a short-term problem in banks where NIMs are going to come down. Yes. And that's the reason they're trading at valuation which they are today. So for us, it is, we buy this we generally tend to buy pain, is the way I describe it. So we are buying this pain in the banks. The other thing we are looking at is some of these, globally oriented stuff like pharmaceutical. Pharmaceutical has been one big area for us, because for 6 years you saw pain in the US generics. Yes. And now that generics is starting to bottom out and, it will plateau out and the prices will stop falling. Pharma is the other sector which will be interesting for us. The third one is chemicals. We've not yet bought it, but there's some agrochemical companies which are starting to look cheap. Again, last 18 months have been bad for them. So we're trying to figure when exactly to time, but it's something which has come on our horizon just now.
Fair enough. I mean, most of your portfolios are very, very concentrated. If I remember right, 1,500 crore rupees is invested between 25 and 30 stocks. So I'm sure, given the appetite that you have in terms of size, banks, pharma and agrochem are something that will definitely give you 4 or 5 stocks to hold on to. Sticking to banks, Jyoti, 3 years were fantastic for PSUs. The kind of money that has been made in Canara, Bank of Baroda, and the second tier PSU banks has been phenomenal, to say the least. Do you feel that the cycle of liquidity is now favoring private banks instead of PSUs because the run up there has been very sharp?
The way we tend to look at it, we just, whether it's PSU or private, we tend to look at it as where is the valuation, where are they in the NPL provisioning cycle, and how much room do they have to grow credit. So at the moment for us, there are a couple of larger PSUs which we own in the portfolio, but otherwise there are lots of smaller private sector banks which are looking very cheap, and they're looking cheaper than the public sector banks also. So,
Yes.
those are the ones which we have in our portfolio. People who, started the NPL cycle late, or there were problems with them, but now things are starting to improve. So those are like some of the banks we own more. So I would say yes, for us in general, private sector looking cheaper than the public sector today.
Fair point, and that's where margin of safety, not only with individual stocks within the private sector banking space, but relative to their public peers, is fairly high. The other segment, Jyoti, that was untouchable for people who started their careers in 1990s was the PSU pack. We weren't very happy with the way managements were run. There was always this fear of supply coming in via OFS. There was always this fear of maybe some part of the economy not doing so well, therefore PSUs bearing the brunt. You mentioned OMCs in particular. Over the last 4 or 5 years, have some of these misgivings in your mind changed, or is it still the same? And we are in a trading PSU segment.
So the way we tend to look at it is there's a valuation for every stock, and then there's a growth prospect. So when you're looking at growth prospect, you have to factor some of these things in that, there will be periods where the OMC will not be allowed to hike prices. So, you have to factor that in, and if, in spite of that, things look very, very cheap, we tend to buy it. Uh, just now the other one which has thrown up is all the PSUs in the defense space because they have a natural advantage. They have already been supplying to them. They have an implementation track record. So, PSUs in the defense space were the first ones which sprung up when everybody was looking at defense. And so, at valuations, you want to buy these sort of stocks. At the same time, you have to keep at the back of your mind that when it comes to PSUs, profit is not the only motive they work on. They also have to work on, maybe more
Yes.
social motives which the private sector may not necessarily work on.
Okay, fair point. They have a public motive, and that's the reason why they are government funded. The other segment which fell on its face was, growth at any price and very high PE stocks, both within the MNC space and the domestic space. How should I say? Valuation Excel sheet seems to have gone for a toss. Were you caught on the wrong side in Valentis, or did margin of safety help?
No, we were not because in our whole philosophy is we walk away
Yes.
very quickly. So for us, it's we tend to buy early when nobody buys it, and we tend to sell very early when everybody gets excited. In fact, we leave some upside for others. So for us, it was we generally don't try to buy these very very high valuation stocks. So I tell people I'll buy a high P if it is totally beaten down cycle earnings, but not when the cycle earnings are normal. And we look at a lot of style changes and what happens in terms of movement. So for us, it was like if you see 2008 to 2020 was where all this buy at any price was working, and after
Yes.
that the style changed and that did not work. And typically in the next upcycle, the old ones don't do well. They tend to underperform for some time.
Okay, but in your own portfolio over the last 18 months, has the churn increased?
No, we run a very low churn portfolio. So in fact, like our churn ratio is less than 20%. It's
Okay.
just a philosophy.
And looking at prices on some stocks that you may have ignored because they did not follow the margins of the principles of margins of safety, do you have this feeling of being missing out on this rally?
So we do, like, basically we have not bought some of the favorites in the market over the past, 18 months. But then we have found other stocks which have given returns which are more or less equivalent to what these gave with lesser risk is what we believe.
Fair point. And what are clients telling you these days? Here is 5 crore rupees, Jyotivardhan. How soon can you turn this into 15 crores? Maybe a couple of months?
We just say we are not the people to do it. We don't do magic in our portfolio.
Okay. And my last question to you, Mr. Jaipuriya, anything that keeps you awake at night? We've had this wonderful Goldilocks market, especially for the last 8.5 months. And it's turned out to be fabulous for people like you and me who are in their third decade in the market. Anything that sort of hits you in the mind कि यार ये ज़्यादा हो गया, something needs to give.
Yeah, so see, everything's worked to perfection today. So, it is like we always think of what will be the black swan. 2 years
Yeah.
back, we were wanting a US recession. It was very consensus. US recession is coming. People have forgotten it. So, I hope next year we're not talking of a major US slowdown, which starts to spook the market.
Chaliye, Mr. Jaipuriya, what a pleasure listening to you, and it's such a wonderful conversation that we had on valuations, on budgets, on margin of safety. My final question to you, sir, is for the last 10 years, we stopped paying attention to the fact that there is a majority government at the center, and a minor black swan occurred on 4th of June when the majority turned into a coalition. Is this something that can derail this rally?
So my view is no. Basically, in fact, we bought on that day when the markets were falling. And because, you have a coalition which has got a big core at the center, which is 240 seats. And this is probably, if you think of all the coalitions we've had since 1991, this is the strongest coalition where, one party itself owns 240. So I think the government will last us 5 years. If you see the way ministries were handed out, it's more like status quo, more or less similar to what happened before the elections. So I think that won't derail the whole economic framework of the country.
Fair point. Thank you so much for your time, Jyotivardhan Jaipuriya. It was such a pleasure listening to you.
Great talking to you. Bye.
Bye-bye. That, ladies and gentlemen, was the founder and managing director of Valentis Advisors Private Limited, Mr. Jyotivardhan Jaipuriya, a very quiet achiever on Dalal Street who speaks less and does more. He runs 2 PMS schemes with a capital of about 1,500 crore rupees that has compounded at 21% CAGR over the last 8 years. I hope you enjoyed the conversation as much as I did. And thank you so much for your time. Please remain glued to Business Today Television for all the financial news updates. Sakshi and I will be back shortly in exactly 57 minutes for the last 1 hour of trade on Dalal Street on this lovely Wednesday afternoon. Thank you for watching. Can we look at the 12,600 Maruti call? This is moving fairly rapidly. It's already moved quite a bit, but this is something which is coming after many weeks. Maybe this is something that catches your interest. The all-time high on this call is somewhere like 629 rupees, now buzzing at about 219. I'm requesting the PCR to show the Maruti 12,600 call expiring July 25th. You'll see that coming on the screen. Mr. Murthy, your view.
See, for me, Maruti is definitely showing clear signs of strength today. And if someone wants to buy call of Maruti, definitely, yes, you can go ahead and buy. But my only point is, one has to also understand buying deeply out of the money options just because you have lower premium into it and with limited capital you can take more exposure. I don't advocate because there will be a lot of time decay also into it. So one can look at buying more and either in the money or an at the money kind of an option of Maruti, or better to take position in futures, go long in future so that this time decay will not impact much. And even if you can buy lesser quantity or even one lot in future, that is much better than going and